Hey there, and welcome to this explainer. I am absolutely thrilled you're here today. We're going to jump right in and open up the hood to conduct a deep, focused due diligence run on a true industrial giant. We're talking about Westinghouse Air Brake Technologies Corporation, or as it's much better known to the market, Wabtec. Look, if you want to understand the modern rail industry, you literally have to understand this company. They've been shaping transportation for over 155 years. So today, we're going to break down their current investment thesis, and we're doing it using nothing but the raw data, their latest SEC filings, and those recent earnings reports. Let's get into it. All right, here is our due diligence checklist for today. First, we're looking inside the Wabtec engine. Next, we'll check their financial health and margins. Third, we'll analyze their massive backlog advantage. Fourth, we'll scope out potential risks and speed bumps. And finally, we'll review their future guidance and outlook. So, Section 1. Inside the Wabtec engine, the core business model. Let's start with how Wabtec actually makes its money. Looking at their 2025 total net sales of $11.16 billion, the business is basically split onto two main tracks. You've got the freight segment, which is the undeniable powerhouse, pulling in 72% of total sales. This segment covers everything from building massive heavy-haul locomotives to developing high-tech digital intelligence systems for rail networks. But you definitely don't want to overlook transit at 28%. The transit side manufactures components for regional trains, subways, and buses. It provides a really crucial, steady track for overall growth, especially as cities globally just keep modernizing their public transit infrastructures. Now this next part, this brilliantly illustrates the hidden genius of Wabtec's business model. Notice the sheer contrast here. 60% of their total net sales actually come from the aftermarket, while 40% come from original equipment manufacturing, or OEM. That 60% aftermarket share is a high-margin, recurring revenue engine. Think about it. Locomotives and transit cars take a massive beating, and they require constant maintenance. Because a certain baseline level of maintenance simply has to be performed to keep things running safely, this revenue keeps churning even when the broader industry slows down. It provides them with incredible stability. And let's see how that builds into an undeniable competitive advantage. That aftermarket revenue is fed directly by one truly staggering number, 24,600. That is Wabtec's massive installed base of locomotives currently in service all over the globe. Every single one of those locomotives represents a future, locked-in pipeline for replacement parts, digital upgrades, and overall maintenance services. Basically, the larger that installed base grows, the wider the recurring revenue moat becomes. Moving right along to Section 2. Financial health and margins, the fuel powering the growth. To see how efficiently Wabtec actually converts those massive operations into capital, let's compare the full year 2025 to 2024. You are looking at a company that is successfully scaling its numbers across the board. Net sales jumped from $10.38 billion to $11.16 billion. But here's the really important part. Gross profit actually outpaced that revenue growth, moving from $3.36 billion to $3.8 billion. And this growth wasn't just organic either. It was heavily driven by strategic acquisitions, proving that management can successfully buy up market share and smoothly integrate it right into their profitable framework. Let's bring things right up to the present day with their incredibly strong Q2 2026 earnings. The momentum here is just fantastic. Sales hit $3.18 billion for the quarter. That's a 17.5% jump year over year. But the real star of the show is the bottom line. Adjusted earnings per share absolutely skyrocketed by 21.6% to $2.76. This proves that the top-line revenue isn't just some vanity metric. It is actively falling right to the bottom line to directly benefit shareholders. And the real story behind this earnings growth? It all comes down to margin expansion. Their adjusted operating margin expanded by 0.8 points, hitting 21.9% in Q2 2026. Management attributes this directly to robust sales growth and highly disciplined execution. Simply put, as Wabtec sells more, they're getting better and way more efficient at actually delivering those products and services. All right, Section 3, a massive backlog advantage, the track ahead. Now, margins and historicals are great, for sure, but we know the stock market is always looking forward. So let this number sink in for a second. $30.93 billion. That is Wabtec's total multi-year backlog as of mid-2026. And remember, this isn't just projected demand or a wish list. These are signed, legally committed orders. Having a backlog that is nearly 3 times your annual revenue, that means your financial train is on a very long, very secure track. It gives them an incredible buffer against any short-term economic turbulence. To give you a sense of exactly how they build a backlog of that massive size, check out this recent milestone. In 2025, they signed an agreement with KZT, which is the National Railway of Kazakhstan. It's valued at approximately $4.2 billion to deliver Evolution Series locomotives along with long-term service support. This marks the single largest locomotive agreement in Wabtec's entire 155-year history. Just a massive win for them. Okay, so we've got expanding margins, we've got record-breaking contracts, and a nearly $31 billion safety net. But as focused learners conducting true due diligence, we have to pause and ask the hard question. What could possibly derail this? What actually acts as a speed bump for a company with this much forward momentum?
That brings us to Section 4, Potential Risks and Speed Bumps. Threat Analysis.
Maintaining a strictly objective tone here, we have to look at the variables that could slow them down. First up are the macro and supply chain realities. Wabtec operates in over 50 countries. That global footprint makes them vulnerable to global inflation, high interest rates, which can obviously delay their customers' capital investments, and sudden shifts in tariff structures. Plus, because their products require highly specialized components and raw materials, any global supply chain choke point or geopolitical instability in the emerging markets where they operate can directly impact their ability to actually deliver on that huge backlog. Next, we have to factor in labor and regulatory hurdles. Wabtec relies heavily on highly skilled, unionized labor worldwide. That means strikes or work stoppages are just a persistent operational risk you have to factor into the equation. On the regulatory side, while rail is arguably the most energy-efficient way to move freight, the company still faces increasingly strict and, frankly, costly global emissions regulations. Transitioning to alternative fuels like hydrogen or liquid natural gas requires massive R&D spending, and there's no real guarantee of immediate customer adoption. Finally, we need to contrast their aggressive growth strategy with the reality of integration risk. Wabtec has been very busy. Recently, they acquired Inspection Technologies for nearly $1.8 billion, Frauscher for around $792 million, and Dellner Couplers. Now, while this brilliantly expands their tech and market share, absorbing billion-dollar global entities carries severe execution risk. If they fail to integrate these companies smoothly, those projected operating synergies and margin expansions we talked about earlier, they could easily evaporate. Let's turn to Section 5, Future Guidance and Outlook. Raising the bar for 2026. Checking the gauges for the rest of 2026. It's always valuable to hear directly from leadership. CEO Rafael Santana summarized their Q2 performance by saying, "The strength of our performance reflects the resilience of our portfolio, the impact of our innovative solutions, and the disciplined execution from our teams." Now that's a very confident statement, but as we know in finance, talk is cheap. We need to see if they're actually backing up that sentiment with their hard financial projections. And while they absolutely are, based on their incredibly strong first half, management actually raised their full-year 2026 guidance. They are now projecting revenue to land somewhere between $12.30 and $12.60 billion. Even more impressively, they raised their adjusted EPS guidance to a range of $10.60 to $10.90. Management clearly expects their recent momentum to just steam right on through the end of the year. So, how does all this benefit the investor? Well, in Q2 2026 alone, Wabtec generated $441 million in operating cash flow, and they used that cash to aggressively reward shareholders, repurchasing $215 million of their own stock and paying out $53 million in dividends, all while managing to maintain an investment-grade credit profile. It really is a textbook example of a company generating enough cash to simultaneously invest in heavy growth and return capital to its owners. All right, so what is the ultimate explainer takeaway here? What should you remember from this due diligence run? Wabtec is a company leveraging a massive 24,600 locomotive installed base to drive a highly profitable, recurring aftermarket engine. They're successfully executing strategic global acquisitions to expand their digital and transit footprint, and they are doing it all backed by a historic multi-year backlog that offers just incredible visibility into their future cash flows. But as we wrap things up today, I want to leave you with this final thought to ponder. As global trade policies shift and the global push for lower emissions requires some massive technological leaps, is Wabtec's $30.9 billion track of guaranteed work enough to steamroll any future economic speed bumps? It is a truly fascinating company navigating a very complex world. Thank you so much for joining me for this explainer, and as always, keep learning.